And even more, you as part of your exercise, you're going to look at your charts and identify, you trace it out on a normal chart. So you go and trace it out. And then I'm going to show you the rules. Okay, you trace it out. This is for a bullish scenario, and this is for a bearish scenario. That's a bullish scenario, a bearish scenario. Sorry? Bullish is going up. Bullish is going up. Bearish is going down. There are some slides I've omitted, but you will get it when I send in the videos. Right? Bullish is saying that it's an uptrend. Bearish is saying it's downtrend. You know how the bulls behave, right? They raise you up with the horn. And comprises of what we call the impulse wave. You know what impulse wave means? Impulse wave is the motive wave, the place where the momentum is going. And it's very obvious. I mean, the market cannot just be going straight up, Abi. It has to take a breather. It has to breathe in, rest, and continue again. ABC as the place where it's resting. And then when it rests, it will continue again. Do you understand? So we will have an impulse wave 1, 2, 3, 4, 5. Then it will rest. Red 2. So the 2 means the one going down. The 1 here means the one going up. The 3 here is for this other one, right? So they just use it to say wave 1, wave 2, wave 3, wave 4, wave 5. Then this is wave A, B, and C. That's why they say A, B, C is the corrective. It's just to label them. You can just say maybe A, B. You can even say M, N, O, P. Yeah, just to label them, to identify them. So that when I'm making reference, it's easier for me. As a matter of fact, what Elliot said is 5 wave counts. And when we say wave 1, it has to be wave 1 because the rule are centered around it. If I say there's a wave 3 somewhere, you know what wave I'm talking about. We're not guessing. So that's the need for the labeling on those waves. Yes, the rules are here. We're going to do one practical example right now. Yes. So these are other concepts Elliot still talked about. Elliot said that even though you have just 1, 2, 3, 4, 5, you are not going to open your chart and see one straight line like this. Is it not? Yeah. When you open your chart, you will see that this line is subdivided. So I can get 1, 2, 3, 4, 5 in this one. And A, B, C here. Right? You see, on the corrective wave, I'm getting A, B, C. On the actual impulse wave, meaning I'm not getting 1, 2, 3, 4, 5 on the pullback, which is the corrective wave. I'm getting A, B, C. Right? Then on the impulse wave, I'm getting 1, 2, 3, 4, 5. On the impulse wave. That's clear. That's clear, right? Next thing I'm going to show you after this slide is the rules. Yes, the rules. This is what we're talking about, right? From here to here is the blue. You can see, even though it is still 5 wave count, we have 1, 2, 3, 4, 5 inside this one. And I'll tell you what, when you open another time frame, even this one here will be broken down again. Is it not? You still see it broken down, waves. So this was what Elliot saw. All the way down to the retracement. You know, even in the retracement, you have 1, 2, 3, 4, 5 here, 1, 2, 3 here, 1, 2, 3. So A here has 1, 2, 3, 4, 5. B has 1, 2, 3. So when it is a pullback, it's just having 3 waves, A, B, C. But when it's an actual impulse wave, it has 5. Take note of that. Okay, so yeah.
My question is,
Wave 1 has to be wave 1. You can't change the labeling. Is that okay? You can't change it. Because there is a rule that says that wave 2, this wave 2 here, wave 2 is a pullback wave, a corrective wave. Your corrective wave cannot come below your impulse wave. If not, it's not a correction again. That's the first rule, right? Let me see if I have. So you can see, you can't have this case. Means that this is not an Elliott wave. It's not an Elliott wave pattern. Is that clear? If these two, look at the second wave here. The first rule is the one I've been explaining since, where we say 1, 3, and 5 are all impulse waves. Abi, that goes in the direction of the market. Then we have 2 and 4 as the counter waves, which are like pullbacks. Now, the second rule here is saying that wave 2 never moves below wave 1. Right? So wave 2 is not supposed to move below wave 1. Right? So if you're asked to identify an Elliott wave, wave 2 can never ever be below wave 1. So when you start counting, you know that if it goes deeper than wave 1, it's either that's not where it started from, or it's not an Elliott wave. And you can't trade it. They actually trade it. I'll show you. I have an example here. That's the rule for wave 2. Then wave 4, they say wave 4 should not overlap wave 1. Meaning that wave 4 should not pass this line and come and overlap here. Wave 4 is supposed to be hanging. I'm not going to wave 4. The reason for that is because wave 3 is usually the longest. Right? Wave 3 is the longest. It's part of the rules. It's part of the rules. In fact,
That's the correct rule.
Yes. Shortest. Wave 3 is never the shortest. In real life, wave 3 is the place where the market starts to break out. When you start 3, that's when there's a drastic change in the price. There's a drastic change in the price. It gets to the news.
does that mean when it goes down?
Up. When BTC was around 10K, it wasn't in the news, right? The moment it got to 18, it got to the news, is it not? Yes. So when there's a drastic increase, it gets to the news. That's wave 3. It's supposed to be the longest. Now, but do you know that when it got to 18, it came down again? Is it not? It came down. It didn't come down. Yes, it did not come down to 10, 9, 8 anymore. Came down. And then what happened next? It now went to the high. Although maybe there have been a corrective wave and a continuation, right? So, but I'm just using it as an analogy so that you understand the picture. So what we are saying, according to what Elliott said, he said wave 3 is never the shortest. So you see what happens. When wave 3 happens, it beats this high. You now see a lot of people buying the high, right? This is what we call fear of missing out, right? It's in the news, comes down, retraces, and then it's now going again, and then you join wave 5.
That's late entry.
Late entry. You're buying the high of the market. People that bought 19K last 2 years ago or thereabout, or 3.
Applying this on the chart is
That gravity too might not work sometimes. That's what it means, right? So, but you know, there are some people in Benin that if I leave this pen like this, they will hold it in the air. They defy gravity. Please don't mind me. Counting, as we're going to do now in the next slide, you see that is a little bit subjective. So, and I like my trades to be very objective. It saves me a lot of emotional, you put yourself in a lot of emotional issues, right? So I'll tell you what I mean. All right, so we understand. And then the last rule is that wave 5 must exceed wave 3. They're not trading any of these. They're not trading any of this. They are trading, if I use BTC as an example now, they did not trade 18K, they did not trade 23K. Right? They allowed the market to settle into a corrective phase. Is that okay? And then now they are trading to the 60K. Do you understand what I just said? I'll show you. See. Okay, now look at this. Look at this in market, right? Who can identify 1, 2, 3, 4, 5, then A, B, C? Launch pack.
Can we zoom in?
Many things now so that you understand what I'm saying. Now, you call this A, which is a pullback from all of this. B. Now, if you call this C, there's something happening here still. Is it not?
Yeah, you cannot call them D.
You can't call it D. So you know what people even do? They will now look at all of this and say, okay, there is a complex. I just gave you simple Elliott wave. There's a complex Elliott wave. And they all have different names. They all have different names. So some people now come and say, you have I, and then IV. So IV rather. So you have 1, 2, 3, 4. So they are waiting for 5. So they now say all of this 1, 2, 3, 4, 5 makes up C. It's quite complex. So you can see C now. So I just pointed out something to you. And then you see people are trading this thing. Let's say this is the 8,000. This is the 18,000 of BTC. Abi? 18,000 of BTC. This is the 23,000 of BTC. It has been quiet for some time. But now it's going to 60. People trade it. You get what I'm saying now? People trade it. Elliott wave, they do. So, but you can see how difficult it is. As a matter of fact, there's a red line coming down here that is saying that as this red is coming now, it's going to get back to this line, and then traders can trade from this point. But if you're trading Elliott wave, just in a stereotyped way, you're going to get stopped out here. Abi? You get stopped out. Market will go and come and stop you out. Even if it doesn't stop you out here, we'll stop you out here. If it doesn't stop you out here, we'll stop you out on wave 5. Right? So so you have launchpad. Please, very, very, very easy. You know, when you look at Elliott talked about 5-wave pattern. These things. Now, do you know that at this point, let me use my cursor so that we can all see. Look at, do you know that here, right? Can you see that place? When it comes down, you can, from here you can think that this is wave 5. Before everything after that cursor, let me bring the highlighter.
Because it's higher than that.
Yes, it's actually higher. See where I'm talking about. This point here is higher than the previous one. And then who says it's not wave 5? But what happens? It still go up again. So there is no specific place. It's too subjective. That's what I'm trying to say. It's too subjective. So that's why we're taking further lessons, because we have to break these things down to the barest minimum, to the point where we now start looking at, you're looking at the point where you can say, okay, can there be some level of certainty, right? Yes. Like, can we say, okay, instead of if we want to trade Elliott, when we open our chart, let's look for 5-wave counts so that we can come in from C. Is it not? Which is the example we have here. This signal, this trading signal. Because that pattern is saying that there is a wedge. Abi? It's a wedge. It's a wedge. This is a wedge. And wedges will break out to the other side. Yes. So they do it, they trade it. This is a very good trading opportunity. If you're an Elliott wave trader, they will take this trade. Okay? So can this market break down to the downside? Yes. Can it? Yes. It can. It can. I told you about S&P 500. Rising wedge breaks out to the upside. Falling wedge break out to the downside is possible. Very possible. But when you see this, you know that the chances of getting this market to go this way is higher. So this is what we call an edge. Is it not? You have added more weight to one side of your coin. That is the 60% we are talking about. Market is in an uptrend, there's a pullback, you look for a way to get in. Line. When we said you will get a launch pack, that everything is resting on that point before you add it as part of the trend line. I don't know if it makes sense to you. Because you can see that when we saw that chart, there were a lot of, unnecessary noise and swings. But there are lines that, see, when we talk about swing, look at on this side now. If I want to join this line going forward, if I want to join it, let's say we don't have all of this information yet. I'm going to make sure that this is a pivot point. We call it swing low and swing high. It has to be a pivot point. It's very important. Trend lines form the basis of they are like the pillar of technical analysis. The line where you have, if it's correct, you now actually have that 60% chance of trading with the trend and doing the right thing. Okay? This is what I'm talking about. Now, there's a point here. There's a point here. Right? We ignore, you can see we've used here and here. Right? So, the point here is that those points have to be pivotal. The market has to be resting on it. The market is not resting on this one. It's not resting on this one. All right? Now, before a point is a valid trend line, it has to beat the previous swing high. Before you say that that point is pivotal, I hope you know. Before I can add a line, before I say that this line is important, it must beat the previous swing high. Look at what I'm talking about. I think I can take that from here. I have my first touch here. I have this here. Oh, you're not seeing it. I'm so sorry. Okay, let me see if let me change the color. Yes. Once you have this, you have a trend. Is it not? Yes. If you have something like this, you have a trend. Is even the blind can see it. So what do traders do? Let me do something that we can use. Market goes up, okay, comes down, right? According to Dow, once this thing starts to go up and breaks here, we now have a trend. See what traders will do, technical traders. Mind you, this is the origin of the trend. So technical traders will connect a trend line like this and wait. As long as it's a valid trend. Remember that what makes it valid is that it broke the high of this swing. This is a swing high. This is a swing low. I'm not saying that there are no points in between. There are. But this is a swing. Once it violates this high, this place now becomes a valid point. So when traders connect here to here, they are waiting for the market to react from that trend line again. That's what technical analysis is about. Once the market comes back to this trend line, guys, as simple as this thing is, it will fetch you money. Once the market comes back, once you have identified a trend, I gave you the three-step strategy. It's that simple. If you have a valid trend, number one, you have a trend, right? The next thing you're looking at is pullback, and it's safer. It's safer to have a trend line so that you have at least an area where you are expecting the market to get to before you buy. Because if the market is showing you candle patterns that allows you to buy here, there is no confluence. Let me put it that way. You can have a reversal pattern here. If you have a reversal pattern in between, the only thing that will make that reversal pattern to work more effectively is that it has approached the line. So traders have number 2, the pullback. And then when the market now comes to this place, they are looking for some sort of candle pattern now. That's where you now hear people talk about candle patterns, engulfing bar. Right? They talk about hammer, shooting star. You know, all these things. Now, when you see a favorable reversal bar on this line, common sense tells you that this short-term trend, which is 1, 2, 3, is it not, is due for reversal. Is it not? It's due for reversal. So, according to Elliott says that this is a minor trend. We have major trends here, right? Here we have minor trend. Here we have the minor trend again. Is it not? So, this minor trend will reverse and produce what we normally have here as what? 5. Trend lines are very, very, very important. Because all those candle patterns that you have read about, they can all happen in the course of this to this area. They can happen. From here to here, you see it happening. But the only time when traders are interested is when it gets to that line. If it breaks, it has violated. What you are looking for here, your step 3, is a breakout. Is it not? That's what you're looking for here on the line. You're looking for a breakout. And is that breakout that you now take 1, then is to 2. So inside here, you get your 1:2. I had that slide where, you know, we had a representation of this. It's not inside the pullback. You are running at a disadvantage. Looking at Elliott wave pattern. I don't know if you understand what I just said. Because if you go too high into this trend, and your stop loss is far. So you got to look for some sort of pullback and then a breakout on that pullback that shows that the main trend is resuming. Okay, so trend lines are very important. We're going to talk about trend lines deeper, but I just need you to understand this introductory concept of what a trend line is. And like I said, before you draw a trend line and count it as a trend line, that point, see, look at this example here. If I am drawing a trend line here, do you know that this is a swing, this is another one, this is another one. But do you know that all of these are not valid? You know, right? Why? Because they did not beat this high. They didn't beat the high. The only time when it becomes valid is when this thing has passed with these green consecutive bars here. Right? You have this green breakthrough. Now traders will put in their lines around this area. And then what are they waiting for? They are waiting for the market to react from this line in the future. Is it not? And then once the market comes, let's say this is where the market got to. Right? Market touches here, and maybe touches somewhere here. I don't know if it actually touched. Right? So, but if it gets to that point, what will traders do? They wait for the pullback. Now, this is what I'm talking about. Inside that pullback, the market can still make attempts to go when it has not touched the line. But it's more effective to wait for it to touch the line. Now, besides the fact that it is deeper, you have a higher chance of getting to 1:2. You have a higher chance of getting to 1:2. Okay? So please take 1, 2, 3, 4, 5, A, B, C. I know. Because I have worked on it over time. Alright, that's why sometimes some of these things will take some time. Natural time.
In essence, looking at the chart, we must be able to count.
Yes. Yes. It's part of the exercise. It's part of the exercise that you're supposed to do. Yeah, so you open a chart. Any chart, randomly. And then I would have opened this thing. I don't understand this connection now. So you open a chart randomly and you can just say 1, 2, 3, 4, 5. And then you follow the rules. This one mustn't exceed this one. This one must be the longest. This is a pullback. It must not go below this. And then that one must be higher than this. That's it. Then you start to wait for ABC. Elliott wave traders, they wait for ABC. Once they see 1, 2, 3, 4, 5, they wait for ABC. Once they get to A, B, they might take A if they want, but they wait for A, B, and C. From C, they are expecting a fresh leg. That's a fresh wave. Expect breakout bars.
So what do you mean by breakout? It's a big candle.
Barubuzu, that thing we call shaved bar. That thing we call shaved bar. Doji followed by shaved bar. Doji is the indecision. Then the shaved bar is the breakout bar. We're going to talk about bars also. So it's a full body.
Is it a breakout bar?
It's a breakout bar, that's what it is. And I explained it when I talked about support and resistance. If this is an indecision candle, this candle to be red going down and it's like this, right? Let's say a little weak. This is a breakout bar. There's indecision here. And then there's a breakout of this indecision. And then I told you that when you have a small body candle like this, it's a trading range. So if you have a trading range which has formed this small candle, once the market breaks out, it retests and continues, is it not? If it breaks out of this trading range, it will retest and continue. This retest, that breakout forms this candle. And this whole trading range forms this one. Is it not? So this is what makes up that breakout. So this is micro analysis, looking at the bar and then saying, okay, let's go to the 1 second time frame or 1 minute time frame. You see that the doji was a trading range and there was a breakout. So something that gives us an early, too much because I'll go into details about this. All right, but I'm just letting you know that this is what trend lines do. They connect the swing lows, the pivot. Let me also let you know that their brother is called the trend channel line. Trend channel lines are the ones that go on the opposite side of the trend line so that it behaves as if it's in a channel. It's always in a channel position, is it not? Because it will react from that line. As a matter of fact, counter trend traders will trade trend channel lines. They place a sell order on the trend channel line that will force the market to come back. And we know the market doesn't go straight up forever. So even if there's consecutive green bars that are going up, it's supposed to stop at some point. Some people use Fibonacci extensions. All right? But the ideal thing I like to use is a trend channel line. So we look at the trend channel line and then we say, okay, yes, there is, a reason for us to stop somewhere. All right, so we're making progress. I mean, there is not so much we can do. We're still trying to make up. I mean, even when we are late, we still stay for 3 hours.